I'm Ben Reppond. Welcome to my YouTube broadcast. Today is April 3rd, 2024. If you've been watching the stock market, I think most of you have, because that's what this is about. You know that the market, and let's just say the S&P 500, has been in an upward direction, an upward move since the first part of November. And we have stayed fully invested since the fourth day in November, and but it has been what you would call a bull run. So if you have been invested, you have enjoyed that. If you are bringing new money into the market, you might want to look at it differently. But I would say for those who have been invested, I'd say stay invested until whatever method you have to get out of the market comes into play, and then make a shift if that's your style. Okay, let's get into the dashboards. The first one is a screen showing all 7 of the ETFs, exchange traded funds, that I want to show you. The 4 from the US, 2 foreign, and 1 bond. So the US indexes, ETFs, are the S&P 500, the Dow, the NASDAQ 100, and the Russell 2000 small cap index. So all 4 of those, and 2 foreign ETFs, the EFA, which is for developed markets, and the EEM for emerging markets. And then the TLT for the long-term government bond. So those are all ETFs, and so they're tracking ETFs, and they track the movement of those indexes. What is an unusual picture that you will not see very often is that all 7 are above all 4 of each of their moving averages. Not a single one is below any of the 4 moving averages, the 20, 50, 100, and 200-day moving averages. So that's indicated with a green dot to the right, measuring 20, 50, 100, and 200. In the yellow box, I show the results this week. Now, this is the movement up or down in the market. And you can see, the S&P was up slightly, the NASDAQ was down slightly, except for all of these were up or down slightly, except for the bonds, which were up more pronounced. And they are still quite a bit negative for the year. But they were, I guess you'd say, oversold and probably ready for some kind of a bounce. Next, I break apart the S&P 500 into its 11 sector components. And you can see the performance of those 11 sectors this past week in the yellow box. So all of them, except 2, so you have 9 out of 11 that were positive, 2 of them were negative. When you look at the year-to-date, same thing. They're all positive except 2 are negative. There are 3 examples where they are below. One of them is below the 20, 50, or 100, 200-day moving averages, and that's only 3. 3 out of 44. So you have 41 examples that are above those 4 moving averages, or all of the 4 moving averages. So the strongest are energy, financials, industrials, retail, basic materials. There's a lot of, at least 3, maybe 4 of these that I named are defensive type sectors. So the market in the first 3 months of the year, generally speaking, has been more oriented to, particularly lately, been more oriented to defensive stocks in kind of a bearish position, even though they are above a lot of these moving averages. So it's an interesting picture. But I would say at this point, it looks like that's the direction. Technology is what, number 7 or 8 or something? I mean, it's way down there. So you're not getting much participation in the growth component of the market. Okay, so let's take a look at the chart, the S&P 500. This is what it looks like for the last year and a half. So, and I drew a black arrow to show you from where it was in October of 22 to present. Now there have been some, a couple of periods where it's gone down a little bit, but by and large, the S&P 500 has been on an upward trajectory since October of 22 and also since November of 23. And you see those bottoms where the market takes off. When I put this on a relative strength basis, I put growth over value. So it's saying which one is the strongest. When this chart, when this line goes up, it's telling you that the market is favoring, or that the growth stocks are more in favor, I should say, than the value stocks. When it goes down, it favors value stocks. So there have been some of both. It began, of course, with a decline in 2022 when growth was way out of favor, and then you can see in the third quarter, mostly the third quarter of this past year, also went down. Or excuse me, the fourth quarter also went down, and and then recently, in the last couple of months, it's been going down. So periods of time where growth has been out of favor and value has been in favor. So to me, very interesting. The S&P 500 relative to the small cap ETF, IWM, shows that, again, there's a lot of up and down, maybe more up and down. And you can see when this goes down, it's favoring small cap stocks. When it goes up, that favors large cap, or the S&P 500. The long-term government bond continues to be in a long-term decline, or you could say intermediate-term decline. And this is a chart going back for 4.5 years. The dollar continues to rise. Now, the dollar is the reserve currency of the world. So when it goes up, this means that other currencies relative to our currency, that their currencies are weakened. Ours is stronger, which means the dollar goes further in buying foreign goods or in foreign markets. And conversely, theirs buys less here. Gold has continued its move up. It's, I could say surging, but it's definitely rising for the last 18 months, and again made another move up this past week. Silver is weaker than gold right now, and it made a move up, but not as pronounced, and you can see that at the far right of the chart. When I put on a relative strength basis, silver versus gold, if it goes up, it favors silver. If it goes down, it favors gold. And so you can see it's been in a downward trajectory for, about 15 months. So that tells you that gold has been a better buy, or should say this, it has performed better on its price relative to silver. Bitcoin continues to rise. It's been volatile lately, but is still in an upward trajectory. Volatility index. Now, this is not exactly the break-even or complete measurement, but I put this black line on here on the right side, which is where I think when it rises above that is where there is increasing fairly significant risk in the market. You can see where it is. It's down at 13, and it has declined a lot. So that tells you there is low volatility in the market, relatively low risk in the market, at least at this point. So it's one measure of risk. Through last Thursday, actually, because Friday was a holiday, but through last Thursday, Asbury Research had all 6 of their indicators positive. Again, another positive indicator when you look at relative to the S&P 500, my dashboards, the volatility index, all of them are saying the same thing. So low volatility in the market, relatively a rising equity market. So this is the cross-asset relative performance chart or comparison put out by Asbury Research, showing the following. High beta, high volatility stocks are doing better than low volatility. Small cap is doing better than large cap. The broad market, the S&P 500, is doing better than the NASDAQ 100. And the U.S. is doing better than emerging markets and developed markets in all three time frames, the last week, the last month, the last quarter. This compares the U.S. versus the world. So there are three countries that, for their stock market, not their economy and not their currency. So only the stock market. So the stock market is doing better in Peru, Germany, and Spain than the U.S. The U.S. is doing better than the following countries in all three categories: Brazil, France, Malaysia, Hong Kong, Singapore, India, no, excuse me, not India, China, Thailand, the Pacific, New Zealand, and the emerging markets in general. I use Switzerland as my example. The U.S., the SPY, which is the U.S. S&P 500, compared to Switzerland, and you can see how well the U.S. market has done versus Switzerland. So each of these countries is different, but this is a good chart to show you the strength of the U.S. versus a European country. Gold and silver. Gold is up to $22.31 spot price per ounce. That is a rise of 3.1% over the previous week, and you saw that in my chart on gold. Silver is up, but not as much, is up 1.3% over the previous Friday, which was rose to $24.95. I think both of them are definitely showing strength at this point. The gold-silver ratio is 89-1, favoring silver as a better buy. A monster box of silver bullion, 500 ounces of silver, is $13,035. This includes $1 markup. Now, I say that with emphasis because I've been buying gold and silver for a long time, over 30 years. And I never, to my knowledge, maybe back in the late 80s or early 90s, maybe I paid as little as $1, but I remember paying $1.10. And everything else I paid was higher than that. And so to go all the way down to $1, what this tells me is the spot price, in my opinion, does not tell me supply and demand because I believe it's manipulated. But I do think that the markup is an indication of supply and demand. So with the price coming down to $1, and by the way, about 2.5 years ago, I don't know if you remember this, the markup was about $5 an ounce. On silver, the Silver Eagle, it was $10 an ounce. Crazy, but that went away and has gradually been coming down. I don't know, will it go lower? It could. What that tells me is, because silver and gold are alternative assets, it tells me that when the markup is that low, it tells me that the money is probably flowing into equities, into other assets, maybe bonds, into other assets and not into precious metals. When the market comes down and people get fearful because of the equity or even the fixed income market, they tend to go into alternative assets, and that is what tends to drive up at least the markup. So for 500, the price per round is $26.07, and it's 50 cents more than that for a tube of 20. When the news comes on that the market is going up, the bull might say, I'm not complaining or anything, but this is blanking nuts. When the bull is saying that, makes you scratch your head. Okay, thank you for watching. If you have questions or comments, leave them in the comment section below.